Welcome to Opal STV. I'm in Stockholm together with Anders Lindell. He is the President and CEO of IPM, Informed Portfolio Management. Anders, tell us a bit of your own background and the history of your company, please.
My name is Anders Lindell. I've been at IPM and running IPM for the past 14 years. So we started the company in 1998. Prior to that, I worked at a Swedish fixed income trading house called the JP Bank, where chiefly we traded Swedish government bonds during the crisis of the 90s, interacting quite intensively with international hedge funds, mostly of the global macro kind. Prior to that, I had a little bit of a consultancy and educational experiences, mixed bag, PhD, non-completed, MIT, where I earned an MBA. Originally, I'm actually an engineer. So for the first couple of years in my life, I actually did something sort of productive for society. I did build control systems for paper and pulp mills. Idea to IPM came actually in late 1997, I dare say, where I and my co-founder, we both worked at the same bank, JP Bank, started thinking about what the next big move among European investors might be. And we were a little bit inspired at the time, I think, by what we had witnessed previously. US houses like Salomon Brothers bringing fixed income trading technology to Europe. And we thought to ourselves, what's going to be the next big move to Europe from the US? And it really started around something called Global Tactical Asset Allocation, which obviously was sort of done even at the European pensions and life insurance companies, etc. at the time. But it was done in the typical fashion where you have investment committees, you listen to your economist, you ponder his estimates or her estimate about the future path of events, and then you adjust at the margin your portfolio allocation, plus minus a few percentage points. So what we had identified was basically GTAA as a concept, as an outsourced investment management service that had been supplied to US pensions and other institutional money since the late 80s. Additionally, it had been supplied to them in a systematic format, or in the format of a systematic investment service, as opposed to decision by committee. So that's really where we started looking at the problem from a European institutional perspective. They had asset allocation, they had maybe even a systematic approach to it, but it was really centered around committee decisions, economic decisions in a discretionary format. And we really wanted to take the American concept of an outsourced GTA overlay, as the term was at the time, a service to European pensions. And this had then to be delivered to them as a systematic investment strategy. We started the firm in 1998. We started talking to, obviously since we're from Sweden, a lot of Swedish pensions. We had certain dealings even with the Swedish government at some point. And then increasingly, spreading the word a little bit to other Nordics and Northern European pensions and institutions. We started trading our first big mandate or sizable mandate for a Dutch pension in 2003. And I guess the reason for that is, despite us trying to be sort of market timers, we hadn't timed our own startup very well. We started really, the peak of the IT bubble, that when we started talking to people, they still thought it was a better idea to invest in Nasdaq stock than pretty much anything else. And when that bubble burst, a lot of the sort of previous risk appetite obviously went out the door. Now, much of that started returning in 2003, and we started seeing some traction for this type of investment service. We started then in 2003 with a Dutch pension and in a managed account format. And since then, we have just added, European institutions to both in the account format and in the format of investment funds, which we started in 2005, another one in 2006, and then a few more slightly later.
So how has your product and service offering evolved over the time you have been around?
The first thing that happened was basically we started in what is delivering what is called, referred to as an overlay service, which is, for people that were around, they know it. For people that weren't, basically a way of adding a stream of alpha to the entire client portfolio. You trade it on their balance sheet, and then can they port it to whatever sub portion of their portfolio they like. And you can do this with or without the support of the client's underlying holdings. Now, what happened in the early part of the 2000s was really that people started moving away from that, and instead regarding what we provided, the sort of overlay trades, basically futures and forward-based trades. They started regarding that as an alpha source in its own right. So it came very natural to us in 2005 and 2006 to start up investment funds, where basically we stripped out the futures overlay that we had supplied previously to clients, and basically put that in a fund format. And this sort of trading style in a fund format, or if you will, isolated in its own right on an account, is very much akin to a global macro strategy. So really what we do in this is, in a systematic fashion, trying to over and underweight currencies, fixed income market, equity markets, based on our view of fundamental developments in and between those markets. And that's really a global macro type strategy, although this is built in a very systematic format, obviously using computer help.
Anders, you say your approach now is fundamental but systematic. Can you explain us more how you work?
I think that's a very, very good question. We think it's a good, we notice a very common mistake. Most people tend to equate discretionary with fundamental, or vice versa, if you will. They also tend to equate systematic with anything that's built on technical analysis. What we say is rather that you can have a basis to formulate your investment views that can be based on fundamental data or fundamental analysis of fundamental data, or it can be built on analysis of price data, more or less technical analysis. So that's a basis for your investment views. Now you can choose to implement this in discretionary or in a systematic fashion. Obviously, if you analyze fundamental information, making discretionary calls, that's really the realm where you have the likes of, Soros and more capital and a few others. Not necessarily to say that they're not systematic, but they're for the most part discretionary in their calls when to time markets. Whereas a very clear-cut, systematic and technically driven investment style would be, your average trend follower, any Winton or AHL of the world. Whereas what we do is really we gather fundamental data, we put that in our database, we feed it to our models, and our models then have what we label a number of risk factors that are based on fundamental information that then, in optimized fashion, come up with a portfolio recommendation. We follow that portfolio recommendation, so hence we systematically implement what our model tells us to do. But importantly, the model uses fundamental information exogenous to the market, as opposed to price information only, i.e., endogenous information.
Within global macro, how do you differentiate yourself? And particularly, how do you fit in a typical institutional portfolio?
I think a starting point is to note that we cater only to institutions. So, you'd find pensions and life insurance and other types of institutional money. We therefore regard, for our strategy, having a clear link to the client's portfolio is quite important for us. Now, if you start from the reverse and say, from a client perspective, if you're a pension fund, what is it you actually need? Let's say you have a startup pension fund that starts with 10 billion, and it has a classical asset allocation. Let's take the most classic of them all, 60-40 equities, bonds. Now, what is the first step for that pension fund if you want to start doing something more intelligent with your portfolio and you want to venture over to alternative investment styles? Well, our answer would probably be someone else than us. Your first starting point is probably get yourself a CTA type manager with the perspective of using that to hedge part of your equity exposure. So you have a clear link between the CTA and your pension assets. Now, the next step would probably be to hire someone like us. There's still a clear link to the underlying portfolio in that we are actually negatively correlated to your CTA, and we're basically uncorrelated to markets in general. So you have a progression from your physical assets to your CTA hedging equity exposure to us hedging a bit of the CTA while still being uncorrelated to your portfolio. And then we think anything beyond that, without having a view of whether it's good or bad, anything beyond that probably doesn't have as tight a connection to your underlying portfolio. Any other hedge fund style probably belongs more in a pure alpha box. That's sort of an add-on to your portfolio to spice it up, but you cannot really link that return stream to the underlying portfolio, whereas in the first two cases you can. And that's where we differ from other discretionary macros, in that since our process is repetitive by nature, it's systematically executed, it's built on simple, relatively stable concepts, built on fundamental data, you can be virtually certain that it will continue to exhibit the negative correlation to your CTA. So it doesn't shift style-wise over time. Whereas obviously if you hire a discretionary global macro, that particular fund may or may not, at certain points in time, exhibit that correlation structure. What is the typical allocation of a pension fund to your shop, or what is the typical range? That's a very difficult question to answer. In terms of range, we've seen allocations from, obviously minuscule people allocating, a few $1 million, few percent of their active risk budget, up to, in the extreme, 35 to 40% of their total risk budget to this particular strategy and to us as a manager. Now, to put that into perspective, we're running in this program at the current time about 4.5 billion, which makes us, sizable, but we're, not by a wide margin the biggest in the market. There are quite a few others that are considerably bigger. So I would think that, institutions on average tend to give this a large room in their portfolio. And that's because it has this link to the underlying portfolio. It is easier for a CIO or an investment committee to make a decision to hand out 10, 20, 30% to the combination of CTA and systematic global macro than it would be to give a 20% of underlying portfolio hedge fund allocation. Only a few people do that. So I would say that for a sensible pension fund, you should probably have a combined CTA and systematic global macro exposure that is probably on par with the all of the other sources of risk that you have in your portfolio, i.e., probably about 40 to 50% of your total risk budget. Probably that pension will have a slightly bigger allocation to CTAs and a slightly smaller to systematic macro. So let's call it anywhere from 10 to 25 on CTA and 15-ish to the systematic global macro space, whereas the rest is made up of other alpha sources.
So how has your strategy done, let's say, since the financial crisis of 2008?
Starting in 2008, we actually had a very, very strong year together with a lot of CTAs and other people. We generated about 30% or so up. 9, 10, about 10% up. 11 last year, we took a little bit of a hit together with, again, a lot of other people. Closed the year, a few percent down. But year to date, we're up again. Current time, probably about 7% or so. I think it is also interesting to note that during this entire period, people have actually treated systematic global macro and certainly ourselves slightly differently than they have treated CTAs and also other alpha sources. We have an extremely liquid strategy, so you can execute. We only execute in very, very liquid instruments, futures and forwards, exchange traded. We offer generous liquidity terms to our investors. Despite that, people did not redeem out of our strategy in 2008 and early 2009, whereas you saw a lot of redemptions in the CTA space. Now, I can't give you an exact answer why that was. We had the same liquidity. Perhaps one explanation might be found in the fact that, as opposed to CTA, people find it relatively easy to understand what a systematic global macro actually does. We're dealing with very, very simple economic concepts that are, anyone will basically understand the basics of it. Whereas CTAs, 80% of that is probably explained by trend following, but the other 20%, that's where I think some people tend to get lost a little bit. So we have something that's very, very liquid, but at the same time very, very easy to simple to understand. So people stayed with us during this whole period. Obviously last year was a bit of a disappointment. This is an absolute return strategy. We should generate returns at all times. Having said that, we are employing a systematic method on an analysis of fundamental data. If you do that, it is virtually impossible to avoid drawdowns. Obviously, there will be a year every now and then when this underperforms. But so far, over this entire period since 2007, people say the financial crisis started there in August, we've done, produced solid results for our investors.
We're now end of August, early September of 2011. So in this current environment, some global macro funds have been struggling. So how is your model coping with the current markets, and what is the outlook that you have for your model?
Well, so far this year and certainly this current period, our model's been, producing according to what it's supposed to do. We're up again about 7% this year. We should probably have been 8, 9, but this is a fair result for the year. And we think that given the type of model we have, we're not overly sensitive to what other people may call regime shifts or external influences on the underlying economy. What our model really centers on is relations or relative behavior across asset markets, equity markets, fixed income currency markets. So in the end, whether we are on the verge of whether we're entering a low inflation scenario, a Japanese development, or we're entering into high inflation scenario based on the amount of money central banks have been printing over the past few years. This model should be robust to that. That's certainly our expectation. That's what it's built for. In the transitional period, when things move from very high or very low to very high inflation, or when central banks unexpectedly start the printing press, or when politicians come with sort of unexpected policy moves, then obviously our model cannot cope with that. So in a transitional period, the outcome is a little bit hard to predict. Once we have passed that transitional period, nations worldwide are exposed to pretty much the same type of regime. We cannot see that our model shouldn't be able to continue delivering as it has done before. I think it's interesting to note that some people think it is difficult. Obviously, this is difficult when you get influences from external sources. But I think it's, over the course of the existence of financial markets, that has been the rule rather than the exception. We probably had an exceptional period starting somewhere, post Paul Volcker up until, just a few years ago, when the total political influence on markets has been relatively limited. Whereas now, going forward, and certainly pre-Volcker, it was certainly anything but limited.
Now, these days, a lot of institutions, when investing with external managers, have obviously high demands when it comes to transparency. How do you deal with those requests?
We, as an organization, are extremely transparent with our clients, but more importantly, with regard to our investment model, the macro model, we're almost equally transparent. We're perfectly happy to show or to give clients the confidence they need by explaining, what the model does, how the model does it, and also what financial instruments the model implements its positions in. We keep clients abreast of developments here by regular client visit, where we discuss and go through any model changes that we do and that we plan. And the ultimate goal here is really, again, client comfort. This is not supposed to be a black box. This is supposed to be, more of an aquarium type model where you can really see what's going on inside. Now, a question that we often get when discussing this is obviously, all right, guys, so you're not afraid of being reverse engineered by clients or by any one competing manager? Well, over the years, we've actually seen quite a few clients that have expressly stated their intention with investing with us as a learning process. They want to learn more about this, and some have been very explicit by saying, we want to learn more because we're building our own models. Well, in the end, most people stop short of doing that for very obvious reasons. It's not uncomplicated. More importantly, it doesn't really make any sense. You might as well buy this from a number of external sources who are really experts in the field rather than try and replicate it. I can build my own bicycle. I don't necessarily do that at home. I go buy a good-looking bicycle instead. Now, from a competition perspective, it is dangerous for us to discuss our models with clients and allow our clients to know what we do and how we do it. It's probably the other way around, actually. If you look at the universe of systematic global macro managers, you would find that the correlation between us is, averaging about zero. There's no correlation, it's uncorrelated. And that's also the way the clients want it, because they want to be able to pick, a couple of different systematic global macro managers and pull them together. Now, if manager A started replicating manager B, well, obviously the correlation between the two would start increasing, and clients would take note, and one of the two, probably the the one who's been copying the other guy's process will be the one suffering. So I don't think really it makes any sense for anyone to try copying what we do, or for us to copy what anyone else does.